The first pressure point is corporate leverage. Over the past 15 years, companies borrowed unprecedented amounts of money, taking advantage of low interest rates to expand, acquire competitors, and fuel stock buybacks. But as rates rose and refinancing cycles reset, these debts became far more expensive. In 2025, more than $1.8 trillion in corporate debt is scheduled to reset at higher interest rates. Many of these companies will see their debt payments double or triple. When interest expenses rise faster than revenue, balance sheets fracture. And when balance sheets fracture, layoffs accelerate, investment stalls, and earnings deteriorate. A stock market built on artificially inflated corporate performance cannot survive long when the floor beneath those companies begins to splinter. The second pressure point is Treasury instability, something the public rarely pays attention to. The U.S. government now carries more than $34 trillion in debt, and as interest rates remain elevated, the cost of servicing that debt spirals higher. This matters because treasuries form the backbone of global finance. They are used as collateral in nearly every major institutional trade. If confidence in treasuries weakens, even slightly, liquidity drains from the system. And when liquidity drains, markets seize. We saw a preview of this in 2022 when the gilt market in the UK nearly collapsed overnight. A similar event in the US would send shockwaves through every asset class: stocks, bonds, crypto, real estate. The system is stable only as long as everyone agrees treasuries are unbreakable, but nothing is unbreakable forever. The third pressure point is the most dangerous: institutional confidence. Remember, markets don't operate on earnings or GDP. Markets operate on belief. Institutions buy stocks because they believe someone else, a central bank, a government, another institution, will absorb risk when things go wrong. This belief is the glue holding everything together. But when the glue dissolves, the structure collapses instantly. In financial history, crises never unfold slowly. They snap. One day the system appears stable. The next day it is in free fall, not because the problems were new, but because confidence vanished. And here is the part they truly don't want you to understand. The market isn't protected by strength, it's protected by delay. Every time the system avoids a correction, the pressure builds. Every time liquidity pushes valuations higher, fragility increases. Every time institutions double down on leverage, the eventual unwind becomes more violent. Delaying reality doesn't diffuse risk, it concentrates it. Today's stock market is balanced on a thin line between engineered stability and structural vulnerability. The hidden forces that have kept it alive: liquidity distortion, index concentration, buybacks, institutional hedging, government spending, and confidence engineering, are still functioning, but all of them are weakening at the same time. The system can operate under 1 or 2 points of stress, but under 6 or 7, that's when history repeats itself. So how does the stock market really work? It works because a massive, interconnected network of liquidity flows, debt structures, leverage cycles, and institutional beliefs keeps it running until something breaks. And when it breaks, the market doesn't gently drift downward. It snaps back to the fundamentals it ignored for years. That is the truth they hide from you, not because it's a conspiracy, but because acknowledging it would shatter the illusion of control that keeps millions of investors calm. The market is powerful, but it is not invincible. It is durable, but it is not eternal. It is engineered, but no engineering lasts forever. Understanding this doesn't mean predicting doom. It means recognizing the cycle. It means understanding that markets rise, fall, reset, and rebuild. And it means preparing yourself not for the crash itself, but for the moment when the confidence holding the entire structure together finally, inevitably, gives way. If you can understand that, then you understand the stock market more clearly than most analysts on television, and more honestly than the voices who pretend everything makes perfect sense. One of the biggest forces is institutional leverage. Major hedge funds, investment banks, and asset managers don't buy stocks the way ordinary people do. They use leverage, borrowing money to amplify their positions. In 2025, margin debt in the U.S. has climbed back above $760 billion, close to its pre-crash peak. This leverage acts like lighter fluid on every market move. When markets rise, leverage pushes them even higher. When markets fall, leverage accelerates the decline. But here's the twist. Because institutions need markets to remain stable to protect their loans, they often coordinate strategies that keep markets inflated far past their natural valuation. This leads to the next hidden mechanism: derivative pressure points. More than $3.5 trillion in options now expire every month, and these derivatives, calls, puts, hedges, volatility bets, influence stock prices far more than earnings or news events. When large options positions accumulate at certain price levels, market makers must buy or sell stocks to hedge their risk. This creates artificial gravity zones where prices are pulled upward or held in place, even if economic data suggests they should be falling. Retail investors think stocks react to headlines. Institutions know stocks react to positioning. And this is exactly what they hide from you, the fact that markets behave mechanically, not emotionally. The narrative of optimism, pessimism, fear, and greed is just the surface layer. Beneath it is a system governed by liquidity, leverage, and risk hedging. As long as those mechanisms remain aligned, the market floats. When they misalign, the market sinks. But there's another force shaping today's market: corporate dependence on cheap labor, global supply chains, and government spending. Many of America's largest companies rely heavily on overseas production, from Mexico to Vietnam to China, and their earnings remain inflated because global wages remain low. Meanwhile, the U.S. government continues to inject momentum into the economy through massive spending programs, even while carrying a national debt that now exceeds $34 trillion. In the last fiscal year alone, the government issued over $2.1 trillion in new debt, much of it absorbed by institutional buyers who need treasury bonds as collateral for their trades. This creates a cycle where government borrowing fuels corporate profits, which fuel stock buybacks, which inflate markets, even when underlying productivity is stagnant. This brings us to one of the most misunderstood truths about the stock market. Markets don't reward strong economies, they reward predictable liquidity. If money is flowing, markets rise. When money tightens, markets stall. It doesn't matter whether consumers are struggling, or savings rates are collapsing, or credit card delinquencies are rising at the fastest pace since 2008. What matters is that the system remains liquid enough for institutions to operate without fear. And yet, beneath this engineered stability, fractures are appearing. Consumer credit has crossed $1.3 trillion for the first time in history. Delinquencies on auto loans and credit cards are rising simultaneously, something that historically signals recession. Corporate bankruptcies have risen more than 30% year over year. And while the average American feels the weight of inflation tightening around them, the market continues to drift upward, not because conditions are good, but because the hidden mechanisms propping it up haven't failed yet. This is the central tension. The stock market is rising on a foundation that no longer reflects the real economy. It is rising because the system that supports it is still functioning, barely. And the people who control that system are hoping it continues long enough for them to profit before the next adjustment. But the question is whether the system is strained. The question is, what happens when the forces keeping the market afloat begin to weaken? That's where we're headed next. And the truth is far more uncomfortable than most investors are prepared for. If the stock market seems disconnected from reality, it's because it is. But this disconnect isn't accidental, it's engineered. The system is designed to delay the consequences of economic weakness for as long as possible. And the longer the delay, the more violent the eventual correction becomes. To see why, we need to look at the three pillars that currently hold the U.S. stock market together, all of which are starting to fracture beneath the surface. Most people think the stock market rises or falls because of simple forces. Good earnings push stocks up, bad earnings push them down. But if that were true, the last decade of market behavior would be impossible to explain. In 2025, the U.S. Stock market is simultaneously overvalued, overstretched, and overexposed, yet continues to float above economic data that should have dragged it down. GDP growth has slowed to under 1.4%. Corporate debt has hit an all-time high of over $13 trillion, and consumer savings rates have fallen below 3%, the lowest level since 2007. And still, the S&P 500 keeps pushing into new territory. So what's really going on? And why does the market keep rising even when the fundamentals don't justify it? To understand how the stock market actually works, you need to ignore the headlines and focus on the forces beneath the surface. The forces that have silently shaped every rally, every bubble, and every crash for more than 30 years. These forces are powerful, invisible to most people, and rarely discussed openly by analysts because acknowledging them undermines the narrative of a rational market. What they don't want you to see is simple. The market is not driven purely by corporate performance. It is driven by structural engineering, liquidity flows, institutional positioning, leverage cycles, and policy mechanisms that prop up valuations even when the real economy is weakening. The first hidden force is liquidity distortion. Over the last decade, the Federal Reserve injected trillions of dollars into the financial system through quantitative easing, emergency facilities, and asset backing programs. Even though official QE ended, its effects didn't vanish. Markets became addicted to cheap liquidity, and companies, funds, and banks structured their portfolios around the assumption that cash would always remain available. In 2025, more than 65% of all daily market volume is driven by derivatives, automated trading, and leveraged products, not long-term investors. This means price movements are often disconnected from fundamentals and instead tied to liquidity flows, volatility triggers, and rebalancing algorithms. When liquidity is abundant, stocks float. When liquidity dries up, they collapse quickly. The second hidden force is corporate self-inflation. Companies are no longer valued based solely on growth or innovation. Instead, many artificially boost their own share price through massive stock buybacks. In 2024 alone, U.S. corporations bought back over $920 billion of their own shares, reducing supply and inflating prices even when revenue growth was slowing. Buybacks don't create new value. They recycle capital to make a company appear healthier than it is. And the average investor rarely questions why companies borrow billions at low rates simply to repurchase shares, rather than invest in productivity. The third force is index concentration. Today, more than 32% of the S&P 500's movement comes from just 5 companies. This means a handful of tech giants can drag the entire market upward even if the majority of companies are struggling. This concentration effect creates an illusion of strength while masking broad weakness underneath. It's why the average U.S. retail investor thinks the economy is booming when, in reality, more than 40% of publicly traded companies have negative operating cash flow. But the most important force, the one almost never discussed, is confidence engineering. Markets don't rise because everything is stable. They rise because investors believe someone else will save them when things fall apart. Whether it's central banks, government spending, or institutional players, the market is propped up not just by money but by belief. When that belief breaks, everything breaks with it. And that's where this story begins. Not with earnings, not with forecasts, but with the unseen system holding the market together. And what happens when that system starts to crack? To understand why the stock market behaves the way it does today, you have to look past stock tickers and quarterly reports and look directly at how money actually moves inside the system. Most investors imagine Wall Street as a marketplace where buyers and sellers meet and negotiate prices. But in reality, markets are shaped by a far smaller group of players, each wielding influence far greater than the public realizes. And together, these players create an ecosystem where prices can rise even when the economic ground beneath them is eroding. The first pillar is consumer spending, the engine of the American economy. For decades, the U.S. relied on a simple formula. If consumers keep buying, companies keep earning, and stocks keep rising. But in 2025, that formula is breaking down. Household savings have collapsed, falling below 3%, while credit card balances have surged to over $1.35 trillion, the highest level ever recorded. Delinquencies on credit cards and auto loans are rising at double-digit rates. Consumers aren't spending because they're confident. They're spending because debt is the only thing keeping their lifestyle afloat. When debt expansion slows, or worse, reverses, corporate earnings tighten, job markets weaken, and the market's most essential pillar begins to crumble. The second pillar is the labor market, which has been praised for its resilience. But beneath the headlines, the picture is shifting. Hiring has slowed across every major sector, while layoffs in tech, manufacturing, logistics, and retail continue to climb. The unemployment rate still appears low because millions of workers have exited the labor force entirely, a silent crisis masked by official statistics. Meanwhile, wage growth is flattening just as the cost of living remains elevated. Companies benefit from this temporary stability, but the foundation is fragile. When labor conditions weaken, consumer spending eventually collapses alongside it. Markets don't crash when unemployment rises. Markets crash when people stop believing that jobs will come back. The third pillar is the most misunderstood: monetary policy complacency. Investors, analysts, and corporate leaders have spent more than a decade operating under the assumption that the Federal Reserve will rescue the market whenever turbulence begins. This confidence is built on the memory of 2008, 2020, and multiple liquidity injections that stabilized markets during crises. But 2025 presents a different reality. Inflation remains firm, hovering near 3.8%, well above the Fed's 2% target. The cost of servicing the national debt has surpassed $1 trillion per year, limiting the government's ability to fuel the economy with more spending. And interest rates, even if they come down slightly, are unlikely to return to the near-zero levels that fueled the massive bull markets of the last decade. This means one thing: the Fed doesn't have unlimited ammunition anymore. They can't flood markets with cheap money without reigniting inflation. They can't cut rates too aggressively without weakening the dollar. They can't expand their balance sheet freely without destabilizing long-term bond markets. The safety net that investors rely on is thinner than anyone wants to admit. And when confidence in that safety net breaks, markets follow, not gradually, but abruptly. But here's the part almost no one understands. The stock market doesn't fall when conditions are bad. It falls when conditions stop improving. Markets move on expectations, not data. As long as investors believe the next quarter will be better, stocks hold. But once expectations turn, even slightly, the system rewires instantly. We're already seeing signs of this shift. Corporate earnings projections for 2025 have been revised downward. Bank lending standards have tightened for 5 consecutive quarters. Manufacturing PMIs remain stuck in contraction territory. And global demand, especially from Europe and Asia, is slowing. All of these indicators point toward one conclusion: the upward momentum holding markets together is fading. Yet despite this weakening backdrop, major indices continue to hover near all-time highs. Why? Because the final force holding everything in place, confidence engineering, hasn't snapped. Not yet. As long as investors believe the mechanisms that supported markets in the past still exist today, the illusion of stability remains intact. But illusions have limits. When the break finally comes, it won't look like a slow decline. It will look like a trapdoor opening beneath a market that spent too long floating on borrowed time. The real question now is not if the system adjusts, but what triggers the adjustment, and how quickly it spreads once the first thread unravels. That's where we go in the final part. To understand how the stock market truly works and what finally breaks it, you have to stop looking at the numbers on the screen and start looking at the structure underneath. Crashes don't begin with panic. They begin with pressure. They begin when one part of the system buckles under its own weight, setting off a chain reaction that spreads faster than anyone expects. And right now, that chain is more stretched than at any point in the last decade.